So today I'm going to challenge one of the most common pieces of financial advice out there. My take is that it doesn't make sense to pay off your mortgage as early as possible. You should keep it as long as possible. Because here's what financial institutions don't want you to realize. Rushing to pay off your mortgage could actually be costing you hundreds of thousands of dollars in lost wealth, potentially even over $1 million in opportunity cost over your lifetime, and this is not an exaggeration. Now, conventional wisdom says becoming debt-free should be your primary goal. But what if I told you that some of the wealthiest investors and financial strategists keep their mortgages as long as possible? What if the emotional satisfaction of being debt-free is actually an expensive luxury that's preventing you from building serious wealth? During my business administration studies and my work in real estate, I discovered how the math behind this counterintuitive approach actually works. So today I'm going to break down why keeping that mortgage might be the smartest financial move you're not making. Let's start with a fundamental concept that should change everything about how you see your mortgage. Opportunity cost is simply what you give up when you choose one option over another. When you put extra money towards your mortgage, you're not just paying off debt, you're also giving up what that money could have earned if invested elsewhere. Think about it like this. Imagine you're 8 years old and you have $10. You could either buy a toy that costs $10 today, or you can invest that $10 in your friend's lemonade stand that gives you back $20 next week. If you decide to buy that toy, your opportunity cost is the $10 profit you didn't make from the lemonade stand. So following this logic, you could say that the toy effectively cost you $20, not just $10. Let's put some real numbers to this. Say you have a $300,000 mortgage at 3.5% interest rate. Yes, interest rates are higher now, but many people still have these lower rates from a couple of years ago. If you now have an extra $10,000, you could, option A, make an extra principal payment, effectively earning 3.5% by avoiding future interest. Or option B, you can invest that money into a diversified stock market index fund with an average historical return of around 9 to 10%. The difference is if you choose that option B and invest that $10,000 for 30 years, which is around the typical mortgage term, at 9% returns, you'd have $132,000. And if you chose option A, you would have saved approximately $19,000 in interest over the loan term. That's a difference of $113,000 on just one $10,000 decision. This mathematical reality explains why many wealthy individuals and financial experts maintain mortgages even when they could easily pay it off. They understand that low interest debt can actually be a wealth building tool when the spread between your debt cost and investment returns is positive. Remember though, that strategy only works if you actually invest the money rather than spending it on consumption. If that $10,000 goes towards a luxury vacation instead of investments, you'd be better off putting it towards your mortgage. So let's talk about a powerful but often overlooked force that makes keeping a mortgage long-term even more attractive. Inflation. Inflation is what happens when prices rise gradually in the economy. It makes your groceries, gas, and Netflix subscription more expensive over the years, but it also quietly reduces the actual cost of your debt. The key idea here is that if you have a fixed-rate mortgage, your monthly payment stays exactly the same for 30 years. But the value of the dollars you use to make that payment, that value keeps shrinking. Think of it like this. Imagine you're earning $3,000 per month and your mortgage payment is $1,800. That's a big chunk of your budget. But fast forward 10, 20, 30 years, your income has likely gone up, but that $1,800 payment hasn't changed. It's still $1,800, but it feels smaller. Let's say inflation is 2.5% per year, which is roughly what central banks like the Fed target. Here's what your $1,800 payment would feel like in today's money. In 10 years, it'll be about $1,400. In 20 years, it'll be about $1,100. And in 30 years, it'll feel more like $860. So even if your payment stays the same, your burden decreases. You're paying back the bank with dollars that are worth less every year. And here's where it gets strategic. While your mortgage shrinks in real terms, the assets you buy with that freed up cash you now have, like stocks, maybe more real estate, maybe build your own business, tend to grow with inflation or even faster. So over time, you're reducing the real cost of your debt while growing the value of your investments. And that's the double benefit of holding a fixed rate mortgage during inflation. So the thing is, if you're aggressively paying off your mortgage early, you're basically handing the bank more valuable dollars today instead of letting time quietly do the work for you. So by keeping your mortgage and investing elsewhere, you're essentially shortening the dollar in a completely legal and risk-managed way. You're borrowing dollars today and paying them back with cheaper dollars in the future. Let's be real, debt doesn't just affect your finances. It also affects your headspace. For many people, carrying a mortgage isn't just a numbers game, it's emotional. There's a deep psychological pull to being debt-free, to seeing a zero balance on your mortgage and feeling that weight lift. And that feeling can be strong enough to override even the smartest financial moves. I call this the psychological freedom factor, the emotional premium people are willing to pay just to feel better about their finances. And that's totally valid. Money isn't just math, it's behavior too. But instead of treating this as a black or white issue, mortgage or no mortgage, there is a smarter middle ground. Rather than going all in on your mortgage payoff or ignoring it completely, Try thinking in layers. Start by protecting yourself. Build an emergency fund that covers 3 to 6 months of expenses. That gives you peace of mind because no debt payoff will help you if you're forced to use credit cards in a crisis. Then take advantage of tax-advantaged accounts. This one depends on where you're from, but if you're in the US, this would mean max out your 401k, IRA, or any similar retirement plans. These offer built-in returns through tax savings that usually beat early mortgage payoff. Next, clear any high-interest debt. Credit cards and personal loans charging 15 to 25% interest, these are the real financial fire you have to put out. And then you reach the mortgage question. And here you don't have to choose a path. You can split your surplus, for example, put half towards your mortgage and half into investments. Say you have $24,000 in extra cash this year, you can put $12,000 to chip away your mortgage and put $12,000 towards investments. This gives you both psychological relief and compound growth. That way, you're not sacrificing so much of returns just to sleep better, but you're also not ignoring your emotional instincts. Think of it this way. If your mortgage is at 3.5% interest, but your investments could earn 9%, aggressively paying off your house early is like paying a 5.5% premium just for a peace of mind. And for some people, that is worth it. If it helps you feel more stable, more confident, and more in control, then do it. But just make sure you're choosing that option intentionally and know what it costs you an opportunity. This is pretty much why personal finance is personal, and often a hybrid strategy is the best one for you because it respects both your logic and your psychology. So the emotional side matters, but it's actually not the only thing we can optimize here. Next up, let's look at one of the most underrated levers in all of this, your tax strategy. Because if you're not factoring in taxes, even the best investment strategies can fall short. If you're only comparing a 3.5% mortgage rate to a 7% investment return, you are missing a key variable. Because depending on where you live and how your money is structured, your after-tax return could look completely different. In the US, this usually means using accounts like 401ks, RIAs, or Roth plans. But no matter where you're based, whether it's the UK, Germany, Canada, India, or Australia, chances are your country offers some version of tax-advantage investing. These accounts give your money extra fuel by either reducing your taxes today or shielding your investment gains in the future. Either way, they boost your long-term returns beyond what a basic index fund in a taxable account might provide. So let's compare two simplified scenarios. If you invest $1,000 into a regular account and earn 8% annually, but pay 25% tax on your gains, your real return is closer to 6%. And if you invest that same $1,000 into a tax-advantaged account, whether that's a Roth IRA in the US, a stock and shares ISA in the UK, or a Riester plan in Germany, and avoid paying taxes on growth, your entire 8% compounds over time. Now compare that to your mortgage interest, which is not growing. It's fixed, and over time it becomes smaller due to inflation. This is why it's often better to invest first and pay your mortgage down later. Because you're not just earning more, you're keeping more. And in some countries like the US, for example, mortgage interest is tax deductible under certain conditions, which means that the true cost of your loan could be even lower than it looks on paper. So let's talk about liquidity and why having access to cash might be more important than you think, and especially more valuable than debt freedom on paper. So you've built equity in your home. That's great, congratulations, but here's the catch. Equity is not cash. It's locked up. Paying off your mortgage might feel good, and yes, it does eliminate debt, but it also reduces your liquidity, which is your ability to access money quickly when opportunities or emergencies come up. And in the real world, liquidity is power. Imagine this. You've been aggressively paying down your mortgage, and now you only owe $20,000. That's awesome, right? But then your car breaks down, or your job situation changes, or the stock market crashes, and now you have a once-in-a-decade buying opportunity. And you've now got $200,000 in equity, but only $400 in your checking account. You can't swipe a credit card to tap into your equity. You'd need to apply for a home equity loan or refinance, both of which take time, paperwork, and fees. And depending on the market or your income at that moment, you might not even qualify. Meanwhile, someone else with the same house, same mortgage, but more liquidity can pounce on that investment opportunity or handle that emergency without any stress. This is why successful investors and financially savvy homeowners often keep their mortgage as long as possible and build cash reserves or liquid portfolios instead. It's not that they don't have the money to pay it off, it's that they would rather have access to that money quickly when it matters most. A fully paid off house may look great on paper, but it won't help you during a cash crunch unless you sell it or borrow against it. By keeping your mortgage and maintaining liquidity, you gain flexibility. You can pivot faster, take calculated risks, or simply sleep better knowing your money isn't trapped inside your walls. So let's put it all together. paying off your mortgage early feels like a win. And for some people it is, but when you dig deeper, you realize the following. Inflation quietly shrinks the real value of your mortgage every year. Your money can work harder elsewhere if you invest it wisely. Emotions do matter, but so does understanding their cost. Taxes aren't optional, but they're optimizable, and liquidity is underrated. Access to cash is often more powerful than reducing debt on paper. So the goal isn't to worship debt or fear it. It is to understand how to use it strategically in a way that fits your life, your goals, and your risk tolerance. So if you're sitting on a low-interest mortgage, don't be in a rush to kill it. There's a good chance it's quietly becoming the best loan you'll ever get. So if this opened your eyes a little bit, consider subscribing for more economic content like this. Thank you very much for watching, and I hope to see you in the next video.